Compound interest is beautifully simple. It is the eighth wonder of the world, as Einstein may or may not have said. Yet, its true power remains a secret to most people, hiding in plain sight. Imagine your money working for you. It earns a little bit extra. Now, imagine that little bit extra starts working for you too. It earns its own extra money. It's a process of your money-making babies, and then those babies growing up to make their own babies. This financial family tree starts small. It feels insignificant at first. But given enough time, it grows into a massive, sprawling dynasty that can change your life entirely. This isn't about getting rich quick. It's about getting wealthy slowly and surely. The shocking part isn't the concept itself. The shocking part is the brutal cost of delay. Let's look at a statistic that should stop you in your tracks. $200 every single month. Start at age 25. Assume a 7% annual return. By 65, you could have nearly $500,000. About $479,000. Now, wait 10 years. Start at 35. Same $200 a month. Same 7%. By 65, you'd have around $227,000. That decade of hesitation costs you more than $250,000. It is the most expensive mistake you can make without even realizing you are making it. So, what exactly is this financial magic? Compound interest is interest on your initial principal, plus accumulated interest from previous periods. Think of a snowball rolling down a long hill. At the top, it's a small handful of snow. As it rolls, it picks up more snow and gets bigger. The bigger it gets, the more surface it has, and the more snow it picks up each rotation. Initially, growth is barely noticeable. Over time, your money's growth becomes exponential. It accelerates, gaining mass and momentum. Today, on February 19th, 2026, this is critical because we have more distractions than ever. The pressure to spend, the pressure to keep up, the pressure to enjoy the now. If compound interest is so powerful and its math is so straightforward, why do so many of us underestimate it? The answer lies in our own psychology. Our brains are not naturally wired to comprehend the explosive power of exponential growth. We think in linear terms. If we walk for 1 hour, we expect to cover a certain distance. If we walk for 2 hours, we expect to cover double that distance. That is a linear relationship. Compound interest doesn't work that way. Its growth curve bends upward, slowly at first, and then almost vertically. This slow start is the first major psychological hurdle. For the first 5 or even 10 years, the gains can feel disappointingly small, leading many to think, "This isn't really working, you know." Another reason we miss the mark is our obsession with the short term. Instant notifications, quarterly earnings reports, daily market fluctuations. We check our investment apps constantly, looking for immediate validation. This short-term focus is the enemy of compounding. The real magic happens over decades, not days or months. Staring at the pot won't make the water boil any faster, and constantly checking your portfolio won't speed up the compounding process. Impatience leads to chasing excitement, which usually just means taking on more risk and paying higher fees. Let's make this real. Meet Sarah. She's 25 years old and has just started her career. After listening to a podcast about personal finance, she decides to take action. She sets up an automatic transfer on her phone. The transfer is just $200 a month. That's about the cost of a few nice dinners out, or the cost of a new gadget. But Sarah is disciplined. She treats this like a non-negotiable bill, like her rent, like her phone plan. She plans to save $200 per month until age 65. That gives her a 40-year runway. We'll use a conservative historical average for our math. Assume an average annual return of 7%. So every year, Sarah contributes $2,400. In year 1, the $2,400 earns about $168. Year 2, she adds $2,400 and the whole pot earns 7%. This repeats year after year. Fast forward. After 10 years, age 35, she's contributed $24,000. Her account is about $34,600. The extra $10,600 is pure compound growth. After 20 years, age 45, she's put in $48,000. Her balance is nearly $102,000. Over 40 years, she's contributed $96,000. But her final balance is about $479,184. Over $383,000 of that is market profit. Now let's consider a different story. This is James. He's 35 years old. The first decade of his career was a whirlwind of establishing himself, paying off student loans, enjoying his youth. He always thought about investing. It was one of those things he'd get to later. Now, at 35, later has arrived. He feels a new sense of urgency about his future. He decides to get serious. Just like Sarah, he commits to investing $200 every single month into a similar retirement account. He is just as disciplined and just as committed. The only difference is his starting point. That gives him a 30-year time frame instead of 40. James invests in a diversified portfolio. We'll assume the same average annual return of 7%. In his first year, his money gets to work, just as Sarah's did. The math is identical, just delayed. He is starting the snowball rolling from the same spot on the hill, but a crucial 10 years after Sarah began her journey. After his first 10 years, at age 45, James has contributed $24,000. His account balance has grown to about $34,600. However, at this same age, Sarah's account was nearly $102,000. They started with the same monthly amount and got the same return. But her 10-year head start created a gap of over $67,000. This gap is not James's fault, it's the mathematics of time. So what happens when James reaches 65? He has invested $200 every single month for 30 years. His total out-of-pocket contributions are $72,000. Thanks to compounding, it has grown to approximately $226,836. Let's put the numbers side by side because this is where the lesson truly hits home. Sarah, starting at 25, retires with about $479,000. James, starting at 35, retires with about $227,000. The difference between them is a staggering $252,000. Let that sink in. $250,000. James was just as disciplined. He invested the same amount each month. The only variable that changed was the starting line. That 10-year delay didn't just cost him 10 years of contributions, it cost him the explosive growth that happens in the final decade of compounding. The reason the gap is so enormous comes down to the nature of exponential growth. In the early years, your contributions do most of the work, but in the later years, your investment returns do almost all of it. At age 55, her account would be worth around $226,000. Coincidentally, about the same amount James ends up with at 65. In her final 10 years, Sarah's account more than doubles, growing by over $250,000. During that same period, she only contributes $24,000 of her own money. The overwhelming majority of that growth comes from her massive existing balance generating huge returns. That first decade of Sarah's investing didn't just grow on its own. It provided the foundation for all the subsequent growth. It was the seed that grew into a trunk, which then supported the massive branches that grew later on. Think about it this way. Sarah invested an extra $24,000 in total. That extra $24,000 of her own money resulted in an extra $252,000 in her final nest egg. This isn't an opinion. It's a mathematical certainty. Time is not just a component of the wealth-building formula, it is the most powerful multiplier. The cost of waiting is not linear, it is exponential. It's a penalty that compounds against you, just as returns compound for you. Hearing these numbers can be both motivating and intimidating. The good news is that harnessing this power doesn't require a finance degree. It just requires action. Here are 3 incredibly simple things you can do today to make compound interest start working for you. The first and most important action is to start now, even if it's small. Don't get paralyzed trying to find the perfect investment or waiting until you can afford to save $500 a month. Open an account today. Put $50 in it. Put $25 in it. The amount is less important than the act of beginning. Time will amplify your small efforts into something significant. Second, use low-fee diversified investments. The power of compounding is diminished by fees. A 1% management fee might sound tiny, but over 40 years, it can consume nearly a third of your potential returns. You don't need to be a stock-picking genius. Invest in a low-cost, broad-market index fund or an exchange-traded fund, an ETF. This approach is simple, effective, and most importantly, it keeps costs down. The third action is to automate the habit. Human willpower is finite. Take yourself out of the equation. Set an automatic transfer for the day after you get paid. Treat it like a bill. The money is moved before you can miss it. Modern technology makes this easy. Even AI-powered apps can move spare amounts for you. These 3 steps, start now, keep costs low, automate, form a powerful trifecta that removes procrastination, high fees, and inconsistent behavior. The math is clear. Compound interest is not magic. It's a predictable force of nature like gravity. It works slowly, quietly, and relentlessly. Sarah, James. They are illustrations of a mathematical reality that plays out for millions of people. The single greatest advantage any investor can have is not a high income, a hot stock tip, or a complex algorithm. It is time. A small amount invested today is more powerful than a much larger amount invested 20 years from now. The 7% return we used is a long-term average, not a guarantee. Markets go up and down. Build an emergency fund so you don't sell at the wrong time and invest to outpace inflation. Remember, investing $200 a month for 40 years can turn into nearly $500,000. Waiting just 10 years cuts that by more than half. The best time to plant a tree was 20 years ago. The second best time is today. You cannot go back and start at 25 if you are already 35, but you can start today. Right now. Let technology help you. Use an app to automate it. Set a calendar reminder. Make it easy. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making investment decisions. If this helped you, subscribe for weekly videos. One nudge closer.